Hello, and welcome to BrightDime's client webinar, Why Your Credit Score Matters. Thank you for joining us. I'm Angela, one of BrightDime's financial coaches, and I will be walking you through the presentation today. We hope you find something to take away and use to improve your financial wellness. Our presentation will take about 15 minutes, and we'll have some Q&A at the end using questions already submitted. Today, we will cover the importance of a credit score. What exactly is a credit score? Where to find it? How it is calculated and the components that matter? How your score is used? What's a good score? And how to improve it. Your credit score is one of the most important numbers in your financial life. It can save you money. It can cost you money. It can help you achieve your goals. By the end of our presentation today, you'll understand these three statements. So let's start out with, what is a credit score? When you use credit cards, home, auto, student, or personal loans, you're borrowing money that you agree to pay back. Your credit score is based on the data from your credit report. Though the exact formula isn't public, we know that the major factors involved are the items from your credit report, and they're used to estimate the likelihood you will pay back the money you borrow. Your credit score changes in response to how you manage your credit, how you pay your bills, and if you take on any new debt. You may have several scores, and they may vary depending on the calculation method and sources of data. Most people have credit information at each of the three agencies, Experian, Equifax, and TransUnion. While the credit details should generally be the same at the three agencies, there are often a few differences due to where different creditors report their information to, which can mean a slightly different score. So where can you find your score? At your bank or credit union, credit card issuers, credit websites, and credit agencies. Some of these places are free, and some may cost a few dollars to get your score. So how does my credit score relate to my credit report? As I mentioned earlier, credit scores are based on the data in your credit report. So that begs the question, what's on your credit report? Credit reports include personal information, current and prior names, addresses, and employers, Social Security number, date of birth, credit account history, collection items, public record items such as bankruptcies, foreclosures, and judgments, and a list of companies who have accessed your report, also known as credit inquiries, and we'll get to that in just a minute. Credit reports will retain negative information such as late payments, debt collections, charge-offs, repossessions for 7 years, while bankruptcy filings typically remain for about 10 years. Positive information can remain indefinitely. One important tip, you should check your credit report regularly, at least once a year. To do that, you can get a free credit report from each of the credit agencies, Equifax, TransUnion, and Experian, once a year through annualcreditreport.com. You can request all three at once, one from each agency, or you can spread them out throughout the year. You are entitled by law to have this free access at annualcreditreport.com. This is the federally mandated source, and any other offers to provide your credit report could be possibly fraud or scams, so be aware of that. So let's break down the calculation of your credit score. It has 5 components. Payment history is 35%, credit utilization 30%, length of credit history is 15%, credit mix at 10%, and new credit also at 10%. So what do each of these mean? Let's start with payment history. It makes up 35% of your credit score calculation. It reflects whether you have been making your payments on time. It is the best place to start to improve your credit score. It is the most heavily weighted because it has been proven as the best predictor of future behavior. So if you're looking for the number one thing to do to improve your credit score, make all your payments on time and in full every month. Recent payments are more heavily weighted, so you can actually make a difference here relatively quickly. If you take one thing away from today's webinar, maybe that's it. Credit utilization makes up 30% of your calculated credit score. This is the amount of credit you are using out of the total amount of credit available to you. For example, if your credit card limit is $5,000 and you have $2,500 on the card, that is a credit utilization of 50%. Lenders want to see credit utilization at or below 30%. If higher than 30%, they see that as a risk. You may not be able to pay it, and it can lower your score even if you pay your balance off every month. So the key is not to max out your cards. It is also a reason not to close old credit cards even if you pay them off. Just put them away and don't use them, leaving the credit line open. I just want to pause here for a second and point out that these two slides, payment history and credit utilization, together make up 65% of your credit score. So focus most of your efforts here. Length of credit history is 15% of your score. It considers how long you've been building credit. The minimum amount of credit history you need to generate a credit score is 6 months on at least one credit account. Open and closed accounts are included. Closed accounts that were always paid on time remain on credit reports for about 10 years, while accounts with late payments remain on for about 7 years from the first date of delinquency. Just because you closed the accounts that had late payments doesn't mean they go away. For credit mix, it's 10% of your score. It considers the different types of credit that you use: credit cards, mortgage, auto loans, personal loans, student loans, etc. It also considers any unpaid loans taken on by collection agencies. The number of each type of account is not as important as simply having experience with different types of credit. New credit, also at 10%, considers how much credit you have recently applied for, typically in the last 6 to 12 months. When you apply for any type of credit, the company you are applying with will inquire about your credit history, which are called hard inquiries, which, as I mentioned earlier, show up on your credit report. Too many hard inquiries in a short period of time can have a temporary negative impact on your credit score. Credit scoring models do consider the possibility that you're rate shopping. For example, if you're buying a home or a car and checking with different lenders as for the best rate available, most will consider multiple inquiries in a short period of time a single inquiry, which is usually within 30 to 45 days, which will have a smaller impact on your credit score than multiple separate inquiries. When you inquire about your own credit, that is a soft inquiry and doesn't impact anything. And then the last bullet, new credit, that also includes whether any of your accounts have become delinquent or brought current. So how is your credit score used? This is where it all comes together. Credit scores are used by credit card issuers and lenders to determine if they will lend you money and the interest rates they will charge you. The better your score, the more likely you'll be approved and the better rates you'll receive. They are important when you want to purchase a home, a car, or even open your own business. Your score impacts your loan approval and interest rates. Insurers also use credit scores to set premiums for auto and homeowners insurance coverage. Potential employers and landlords, as well as cell phone companies, utility companies, they may also look at your score to determine whether to do business with you. Once they do decide to do business with you, you're still not done because everyone does not pay the same rates. This is why your credit score matters. It can save you money, it can cost you money, and it can help you achieve your goals. It's all connected. So what's a good score? Credit scores typically range between 300 and 850. Credit scores between 580 and 669 are generally considered fair. 670 to 739 is good. 740 to 799 is very good. 800 and up is considered excellent. There are minimum scores if you're applying for a mortgage, typically around 600 depending on the type of loan. And even if you get approved for a loan, the interest rate you'll receive is also impacted. Remember, everybody does not pay the same rate. To wrap up with the presentation, here are some takeaways I've emphasized throughout the presentation that will help you improve your score. Check your credit report regularly. Make sure everything is accurate. If you do find a mistake, and they do happen, contact the credit agency to correct it. And remember the free credit report from each of the credit agencies once a year through annualcreditreport.com. That's my last commercial on that one. Make sure your payments are on time and make them in full every month. Keep your credit utilization at 30% or less. And remember that open and closed accounts are included in your score. Experience with different types of credit accounts help. And if you're rate shopping for a car or a home, do it within a 30 to 45 day period. We are now at the Q&A portion of our presentation. We had some questions that were pre-submitted before the webinar that we'll cover now.
Thanks, Angela. That was great. We've got 3 questions to cover, but first, I want to remind everyone listening that you can always ask us questions about webinar topics or anything else financial wellness related by emailing us at ask@brightdime.com. First question. I'm one of those people who puts everything on my credit card, but I do pay off the balance every month. My balance is usually more than 50% of the card limit during the month. Does that impact my credit score?
Yep, it sure does, because credit card issuers report balances to the credit agencies around the time that the billing cycle closes, so before payments are made and credited. So if you have a large balance, it can look like you have high utilization ratio even if you pay the whole thing off. A quick tip on that, a good way around this is to pay down the balance before the close of the billing cycle or make several payments over the month to keep the balance down. You can call your credit card issuer to find out what date balances are reported to your credit agencies.
Thanks. That's good to know. It'd be easy to think you had everything under control, but actually we're having trouble with that in-month balance. Second question. When I pay off a credit card, should I close the account or put the card away in a drawer but keep the card open?
Most of the time, I would say just put it in the drawer. By closing it, it reduces your total credit limit available, which makes your credit utilization ratio worse. However, if it has a large annual fee or it tempts you to spend more, then just close it. Just don't close several at one time.
All right, our third and final question. I get offers for store credit cards, it seems like every time I check out at a store. Should I open these and take advantage of the discounts available?
Most of these retail credit cards have higher interest rates and can only be used at that one store, making them limited purpose and your wallet thicker. When you do open a credit card at these stores, it is a hard inquiry on your credit report, as we talked about earlier, which is a small temporary ding to your credit score. If it's a store you shop at frequently and gives great discounts, you may consider it, as long as it doesn't tempt you to spend even more. Otherwise, you should just pass on opening up new credit cards at several stores just to save a few bucks.
All right. Thanks for joining us. If you still have any questions about credit scores or other financial wellness topics, BrightDime's always here to help. You can let us know at ask@brightdime.com, or you can log into your account and press the coach button. We'll see you next time.